So, what if I told you the secret to building serious wealth wasn't about all that frantic trading or staring at complex charts all day? What if it was about a coffee can? Yeah, you heard that right. We're going to dive into this really powerful idea called coffee can investing. And it's all about how simplicity and discipline might just be the real path to financial freedom.
But before we get to the solution, we kind of have to understand the problem, right? And it's a big one. It's this dilemma that trips up even the smartest, most successful people out there when they try to grow their money. And to really get it, let's look at a story that, well, it might hit a little close to home for some of you.
So let's talk about a guy named Mr. Talwar. Now, this is a successful corporate exec. By all accounts, a guy who did everything right in this career. But then, at his son's graduation, this weird feeling creeps in. He's 50 years old, he takes a hard look at his finances, and he feels totally insecure. He realizes he just hadn't saved enough for retirement. How does that even happen?
So, what went wrong here? Well, Mr. Talwar fell into some super common traps. You know the ones. Constant trading, trying to time the market perfectly, always chasing those short-term gains. All that activity, it created this whirlwind that was really good at just one thing, making his broker rich from fees. And all the while, this silent killer, inflation, was just quietly eating away at his hard-earned savings year after year.
Okay, get ready for this, because this is the number that just changes everything. When Mr. Talwar finally sits down with a real financial advisor, the truth is, well, it's staggering. After 27 years, 27 of saving and actively investing, all that stress, all those fees, it all boiled down to an annual return of just 4%. 4. He was basically running on a treadmill, going nowhere, with all that effort just barely keeping up with inflation. It's wild.
And this leads to the really big question, right? Because Mr. Talwar is a smart guy. And he's not alone in this. Even geniuses like Sir Isaac Newton lost a fortune making emotional calls in the market. So the problem isn't about being smart, it's about the approach. So what's a better way?
Well, the answer, it turns out, is refreshingly simple. It's a whole philosophy that just cuts right through all the noise and goes against everything you hear about constant trading. It's called the coffee can portfolio.
So what is it? At its heart, coffee can investing is built on two super simple pillars. First, you do the upfront work to find and buy a bunch of genuinely high-quality companies. And second, and honestly, this is the hardest part for most of us, you just hold on to them for a long, long time. We're talking a decade, maybe more. No touching, no trading, you just let them be.
You might be wondering, why the heck is it called a coffee can? Well, the name actually comes from the old American West. A time before you had a bank on every corner. People would take their most valuable stuff, cash, gold, property deeds, and stick it all in a sturdy coffee can. Then they'd hide it somewhere safe, like under the mattress, and just forget about it. The whole idea is to treat your very best investments with that exact same buy it and forget it mindset.
And look, this isn't some newfangled idea. It perfectly captures a philosophy shared by the greatest investors ever. It's exactly what Warren Buffett was talking about when he famously said, "Our favorite holding period is forever." It's all about having the conviction to let great companies do what they do best, over decades.
Okay, so this all sounds great in theory, but how do you actually find these high-quality companies, right? The coffee can approach isn't about throwing darts or just going with your gut. It's about using a really simple, data-driven filter to find the absolute best of the best.
So here's how we find them. The system uses just two simple but super powerful filters. That's it. First, we're looking for consistent growth. The company's sales have to have grown by at least 10% year after year. Second, they've got to be efficient. They need to generate what's called a return on capital employed, or ROCE, of at least 15%. You can just think of ROCE as a grade for how good a company is at turning a dollar of investment into actual profit. And let me tell you, finding companies that can clear both of these hurdles consistently, it's really, really rare.
And here's why these two rules are so powerful. It's because they don't just find companies that are having a good year right now. No, they pinpoint businesses that have these deep, lasting competitive advantages, what serious investors call a moat. These are the kinds of companies that can handle pretty much any economic storm and just keep on growing, not just for years, but for decades.
All right, so this brings us to what might be the most counterintuitive part of this whole thing. We live in a world that screams at us to hustle, to be active, to always be doing something. But the coffee can strategy says the real key to success is to do nothing. Let's dig into why that is.
Just look at the comparison here. It really draws a clear line in the sand, doesn't it? On one side, you've got active trading, tons of activity, high fees, lots of stress, and like we saw with Mr. Talwar, the results are often meh, disappointing. And then on the other side, you've got the coffee can way. Low activity, a laser focus on business quality, almost no fees, and just a much, much calmer path to what has historically been really strong returns.
You know, there's a perfect metaphor for this. Think of your portfolio as a garden. You'd go out and you'd select the absolute best seeds, right? You plant them, and then you let them grow. You wouldn't go digging them up every single day to see if they're working, would you? Of course not. You plant them in good soil, and then you have the patience to let nature do its thing. All that constant tinkering just messes with the roots.
And nurturing that garden, well, it takes a totally different mindset. It's not about being some frantic trader who's reacting to every headline and every little market dip. It all comes down to a really fundamental shift in how you think. You have to stop acting like a stock trader and start thinking like a long-term owner of a business.
So really, this whole thing boils down to a simple three-part manifesto. First, trust quality over all the noise. Focus on how great the company is, not on the day-to-day chatter of the market. Second, just like compounding, do its magic. Your biggest advantage is time, so you have to be patient and cut those fees down to nothing. And finally, number 3, embrace simplicity. A winning strategy doesn't have to be complicated. In fact, it's usually better if it isn't.
And that brings us to our last thought here. You know, the funny irony of the whole coffee can metaphor is that for a lot of people who trade too much, pay crazy high fees, and get terrible returns, their money might as well actually be sitting in a coffee can under the mattress, not growing at all.